Hello and welcome to today's video. Today I will be covering PayPal stock. It is a company that at least on the surface looks like it keeps making all the right moves, but market always keeps just don't caring. I will dive in latest earnings, look at their business, so stay tuned. If you are looking for a solid investment broker, I personally use Interactive Brokers. They have decent platform with great mobile app. Stocks, ETFs, options are just to name a few optionalities. They offer combined with low fees, of course. Use my link in the description of the video to earn up to $1,000 in their stock. Now disclaimer. Before we start, disclaimer, nothing here is a financial advice. I'm just one person with a microphone. Always do your own research. PayPal continues to deliver solid earnings, yet the stock seems to get punished regardless of what the company reports. This naturally raises the question, is the market being irrational, or is there something happening beneath the surface that investors are missing? That is what I want to explore today. But before drawing conclusions, it is important to look at what PayPal is actually doing at the business level, starting with the most recent earnings and strategic focus. So PayPal is in the middle of broad modernization effort focused on its brand checkout experience across three areas: online, offline, and agent payments. These are not buzzwords, they represent distinct part of PayPal ecosystem and address very different use cases, competitive pressures, and long-term growth opportunities. Online refers to transactions where PayPal is clearly visible to the users and the brand is in front and center. This includes payments made directly throughout the PayPal app, PayPal branded checkout buttons on merchant websites, Venmo checkout, subscriptions, and peer-to-peer transfers. In this segment, PayPal competes on user experience, trust, speed, and value-added services such as wire protection and one-click checkout. The company is investing heavily in improving conversion rates, reducing checkout friction, and strengthening the PayPal brand as a consumer-facing payments platform. Offline represents payments where PayPal infrastructure is used, but the PayPal brand is not always obvious to the end user. This includes unbranded processing throughout Braintree, enterprise merchant solutions, and card-based transactions routed throughout PayPal network. For example, when a user pays on an e-commerce platform or in mobile app using a saved card, PayPal may be handling the transaction behind the scenes without the consumer actively choosing PayPal. This business is lower margin but extremely important at scale as it drives large payment volumes and embeds PayPal deeply into merchants' ecosystems. Agentic payments are the most forward-looking part of PayPal's strategy. This refers to future where AI agents act on behalf of the users to execute tasks, including payments, thinking of an AI assistant that can book travels, order groceries, manage subscriptions, or pay recurring bills automatically based on user preferences and constraints. In this world, payments needs to be programmable, secure, and trusted by both users and merchants. PayPal is positioning itself as the financial layer that enables these AI-driven transactions, leveraging its identity, risk management, and global payment capabilities. These three areas form the core of PayPal operation strategy today. Online drives brand and user engagement, offline drives scale and merchant integration, and agent lays the groundwork for the next evolution of digital commerce. Understanding this framework is essential before judging whether the market is fairly valuing PayPal or overlooking the depth of what company is building. What PayPal was bragging most about is its transaction margin dollars, which grew 7% quarter over quarter. A transaction margin dollars is a metric that describes how much money PayPal keeps from the total payment volume, meaning this portion of funds flows throughout the channels and remains with the company after transaction-related costs. As shown in the graphic above, this success is closely linked to improvements in checkout, PayPal Venmo, and omni-channel capabilities. Omni-channel refers to PayPal's ability to connect online and offline payments into a single ecosystem, allowing customers to use the same PayPal or Venmo credentials whether they are paying in an e-commerce checkout, a mobile app, or a physical store. US branded online experiences have shown continued growth since the third quarter of 2024. Now we see that Venmo services are showing strong growth across their own verticals, with peer-to-peer payments, the Venmo debit card, and Pay with Venmo, all performing significantly better than in 2023 and delivering roughly 20% year-over-year growth. Peer-to-peer remains the core engagement driver, keeping the users active within the Venmo ecosystem, while the debit card and Pay with Venmo extend their engagement into everyday spending and merchant checkouts. Together, these verticals are turning Venmo from a social payments app into a more complete consumer payments platform with stronger monetization potential. Now on to enterprise payments. So they are showing a strong rebound in growth. While activity is still below the levels seen in the second quarter of 2024, the segment has improved meaningfully since the fourth quarter of 2024. This rebound suggests that merchant demand and transaction quality in PayPal's enterprise and unbranded channels are stabilizing after a weaker period, contributing more positively to overall payment volume and margins. Now, while PayPal continues to improve its existing business lines, it is also clearly positioning itself for what it sees as the next phase of digital commerce. This effort spans multiple fronts, from expanding its global footprint to securing partnerships with major technology players such as Google and OpenAI. At the same time, they launched their own stablecoin PayUSD, gives the company direct exposure to crypto rails and programmable money. Taken together, this move suggests that PayPal is not only defending its current position, but actively trying to place itself at the forefront of the next major expansion in digital payments and commerce. Following these positive developments, the company also modestly increased its full-year guidance. While the upgrade was not significant, it still reflects greater confidence in execution and operating momentum as the year progresses. Following all these developments, one could expect the stock price to be performing better. Instead, it continues to struggle, and when viewed throughout certain valuation lenses, which I will discuss shortly, the disconnect becomes even more surprising. Before getting to valuations, it is worth highlighting some of the less positive developments. The total number of payment transactions declined 5% year-over-year. This decrease is primarily related to enterprise payments, a segment that, as discussed earlier, is still in the recovery phase. Importantly, that recovery appears to be progressing well, with a return to growth expected in the fourth quarter. Another area of weakness is transaction per active account, which fell 6% year-over-year. Despite these marginal slowdowns, revenue and earnings continue to grow, reinforcing the idea that PayPal is deliberately shifting its focus from pure transaction volume toward higher quality, better monetized activity. So now I'm not suggesting that these signs of slowdown should be ignored. Rather, the point is that investors should focus on the bigger picture. The business is still growing, margins across most segments are improving in the low to mid single digits, and when this is combined with an aggressive share buybacks program, the resulting valuation looks increasingly attractive at current levels. With the share count falling below 1 billion over the past 2 years and the stock trading near the same price level seen at the beginning of 2024, the setup for valuation looks increasingly compelling. When we look at history, the picture becomes even more striking. Over the past 10 years, the average price to earnings multiple has been around 37.7, while the current price to earnings ratio stands at just 11.2. This implies potential upside of roughly 70% from current levels. Notably, this is also the lowest PE relative to its performance over the comparable years when comparing year-end closing prices. Now turning to price to sales, a metric that some investors may view as a secondary but still worth monitoring. The signal remains consistent. With a current multiple of 1.71, PayPal is not only trading at the lowest price to sales ratio in its history, based on my calculations, but this also valuation implies close to 70% upside from the current levels. The same story appears when looking at price to operating income. At a multiple of roughly 9, PayPal is again trading at the lowest level it has ever seen, while suggesting more than 70% upside if valuations were to normalize. To summarize, we are looking at a company that is still growing, steadily improving margins, aggressively buying back its own shares, and holding more cash than debt on its balance sheet. Based on the valuation metrics discussed above, PayPal is currently trading at its cheapest levels of the past decade, creating a setup that is difficult to ignore from long-term perspective. Did I mention that they started dividend payouts? Well, if not, yes, they did. Now that I showed my bullish case for PayPal, I also have some real concerns I will discuss now. So, when discussing what could go wrong, there are two main risk areas from my perspective. The first is competition, which is the more obvious one, and the second relates to long-term growth visibility. The competitive landscape is intense. PayPal operates in fintech, a space where barriers to entry are relatively low and well-capitalized incumbents are constantly expanding their reach. Competition comes from traditional payment networks such as Visa and MasterCard, as well as large technology platforms like Google, Apple, and Amazon, throughout products such as Google Pay, Apple Pay, and Amazon Pay. Direct fintech competitors like Square and SoFi also add pressure, and even crypto-based payment rails can be considered part of the broader competitive set. Competition in this space should not be underestimated. That said, PayPal's continued ability to grow revenue and earnings suggests it does have a durable position within the ecosystem. If the company had no real edge, whether throughout scale, brand trust, merchant relationships, or risk management, it would not be sustaining growth in such a crowded market. PayPal clearly has its place, even if that place is constantly being challenged. The second risk is long-term growth visibility. The market appears to be discounting PayPal because it does not yet see a clearly defined next major growth engine. I partially agree with this view. Much of PayPal's current progress comes from improving and optimizing existing services, which supports steady but relatively modest growth. However, there is an important caveat. PayPal is actively trying to build its next growth vectors. This can be seen throughout initiatives such as integration with OpenAI and its focus on agentic commerce, as well as the launch of its own stablecoin and broader exposure to crypto-based payment rails. These moves indicate a management team that is aware of the challenge and willing to take calculated bets rather than standing still. While it is still too early to say which, if any, of these initiatives will become a meaningful long-term growth driver, the current valuation combined with aggressive share buybacks and a dividend provides a meaningful cushion. This makes the risk profile more balanced and supports the case for being comfortable holding the stock while waiting for greater clarity on future growth. My take is that from my experience, so I mostly rely on local internet banking and Revolut for everyday payments. Recently, however, I wanted to book a specific sport activity, and for international customers, PayPal was the only available payment option. I decided to download the mobile app and give it another try. I had used PayPal before, but that was a long time ago, roughly 7 to 10 years back. At the time, the desktop experience was far from enjoyable, from my experience. And what stood out immediately now was how smooth the user experience is today. The app was easy to set up, navigation was intuitive, and the payment flow felt fast and frictionless. I have already used it several times directly throughout the app without any issues. While this is obviously a very small sample size, it still reflects a real user experience and reinforces the idea that PayPal efforts to improve branded checkout are not just marketing language, but tangible product improvements that user can actually feel. Lastly, from a price perspective, even though some may argue that the stock has been going nowhere, the last 2 years tell a different story. During this period, the stock traded in the low 90s range at twice dipped into the low 80s, offering meaningful upside from those levels. While my valuation models point to higher prices over the longer time horizon, shorter term price action is better assessed throughout technical analysis. From that perspective, the first meaningful upside range sits around $78 to $80. With the stock currently trading near the lower end of its 2-year range, this area looks attractive enough for me to initiate a small position. My plan is to add gradually on a weekly basis if the price remains in this zone or moves lower. For now, options are not particularly attractive to me, as I would prefer to see additional weakness before considering that route. Okay, this is it for today's video. If you want full written deep dive on this topic, check my Substack. Also, for more daily insights and market updates, check my X account. And if you want to have more educational content like options, for example, check my website. Like, subscribe as a sign of support, and see you in the next video. Bye.